Welcome everybody, my name is Paul Buitink and today I have the pleasure to talk to one of the best informed and open-minded central bankers out there, David Andolfatto, economist at the St. Louis Federal Reserve Bank. The topic for today is Central Bank Digital Currencies. Hi David, welcome, how are you?
Doing very well, thank you, Paul.
Good to talk to you. Let's start with a little bit about yourself. So if you could tell a bit more about yourself and how you went from being a construction worker to becoming a central banker.
Sure, well, very briefly, I grew up in Vancouver, British Columbia. My parents were Italian immigrants, and my father naturally was a construction worker. So I grew up in that kind of world, and I began my early career as a construction worker doing drywall and wall finishing. And I was quite happy doing that. Actually, this would have been in the late 1970s and 1980. And of course, that was right when the big recession hit. And what I noticed at the time, I was working in commercial, a lot of commercial work, and also working on the side doing residential, renovating basements and things like that. But what I noticed was that suddenly, I got business was drying up. My piecework work was drying up, and eventually my union job, I was laid off. Interest rates were soaring to 20%. People were walking away from their homes, real estate prices crashing, and I was left kind of just bewildered and confused as to what happened. So because I had nothing else to do, I decided to go back to school and take a degree in economics to try to learn what happened. So through that route, I eventually got a PhD in economics. I taught in academia for about 20 years, and mainly in Canada. And then in 2009, I was recruited by the St. Louis Fed to come to work at a central bank, just right around the time of the financial crisis.
Interesting time to start.
Yep.
Yeah, and fast forward to 2020, everyone seems to be talking now about a new product that you guys are supposed to deliver, the Central Bank Digital Currency. I remember the first time I heard about it was 5 years ago in a paper from Michael Kumhoff, IMF economist. And of course, for a few years it was just talk, but now it seems like most central banks are actually either designing or even implementing a central bank digital currency, with China being ahead of the pack, I believe. What is this all about? Could you first explain to us what is a central bank digital currency?
Yeah, well, the first thing to keep in mind is that the term means different things to different people. So there are different versions of it, and there's going to be, let me just describe what the basic version is. The basic version is just very simple. It's just basically permitting everybody to have a direct account, either direct account with a central bank or intermediated in some way by a private bank. But the simplest version is, imagine everybody has a bank account with the central bank. In a way, everybody already does have an account with a central bank in the following sense. If you take a look at the money supply, all of the money supply consists of liabilities of some bank, either a central bank or a private bank. The private bank liabilities are like checking deposits. What are the liabilities that form a central bank balance sheet? The liabilities are reserves, which are electronic ledger entries, and physical paper, cash. And so there already exists central bank digital currency in the sense that a fraction of the liabilities printed or issued by the central bank are already in digital form, but they're only available to the banks themselves as reserves. The rest of us are also able to have central bank money, but we're only allowed to have it in paper form. So the basic idea behind central bank digital currency is to say, hey, listen, maybe there was a time in the past where this kind of division made sense when the technology was not so well developed. We didn't have the internet, for example, and maybe it made sense to kind of reserve the digital currency just for clearing purposes among banks, and to let the rest of the population use the paper version of the central bank money. But today technology has evolved, and in particular the internet and all sorts of developments that make communicating to the internet more secure, more reliable. So it's now possible for us to directly contact these databases electronically. Perhaps it's time to revisit this question and ask whether or not it still makes sense to restrict access to the digital part of the central bank's liabilities to just banks, or whether it might not make sense to let everybody have a bank account with the central bank. That's kind of the basic version.
And do you consider yourself a proponent?
I consider myself, I grew up as an academic, and so I'm not like a politician or an advocate so much as I ask questions, and I'm pretty much most of the time kind of agnostic as to, I can see the merits that I can see merits to the case. I can see downsides. I think that they're my own view is I'm very agnostic. I think that what's most important is how things are designed. And it's not so much whether the central bank provides the design feature or whether the private sector or whether it's some private-public partnership. So I'm kind of agnostic on that score. But by and large, I have been trying to make a case that, hey, look, these are we already let people have the direct access to the paper version of the central bank's balance sheet. Why not let them have access to the electronic component of their balance sheet? That's just a question I can ask, and it's kind of makes sense in some ways.
Yeah. So in a way, it's just upgrading access to the central bank balance sheet that consumers and companies have had for ages, but just making sure it also becomes digitally available. But because it's interesting, because a lot of bankers that I speak with, especially commercial bankers, they say, well, it's not a good thing to have central bank digital currencies because it could lead to funding problems for commercial banks. But then I usually counter that indeed by saying, but look, people have had access to public money already for such a long time. So what's the big deal? So how would you respond to that?
Well, I mean, in terms of how a banker might respond to that is to your last statement is that, yes, indeed, the public money was introduced and crowded out private banknote issue and, increased bank funding costs and, and created all sorts of issues for banks. I mean, that's how, if I was to take a position in favor of the bank's position, I would say exactly that. So, I often cite recently, I came across some empirical work by Anna Grodecki-Messi, who's looked at the case of the establishment of the Bank of Canada in 1935. And what the Bank of Canada did was to outlaw basically the private note issuance of the Canadian banks, the Bank of Montreal, Bank of Nova Scotia, et cetera. And there was, some great consternation about bank profitability, what this would do to investments, bank financed investment. And Anna takes a look at the data. She's got a nice data set. My recollection now is that she finds that indeed, I think profitability was affected in the short run, but that she finds no evidence that bank lending suffered in any material way. So yeah, you raise a good point. I mean, we already have, let's take as given, we already have the central bank paper money. And for sure, I think the banks are right to be concerned about funding pressure because obviously the product that just think of the central bank as another bank.
Yeah.
And in that sense, it's a competitor. And I guess critics would argue, yeah, but it's an unfair competitor because it's the government and it has monopoly power over the ultimate object of settlement. My response is, so what? I mean, this institution has been set up, and the key issue is whether it's been set up properly, and it's been designed to serve the broader interest of society. That's the whole point. Yes. It could lead to funding pressure for banks, but I mean, I actually have a recent paper on this actually that was published in the Economic Journal that I lay out kind of a theoretical model to kind of study theoretically what the impact might be on banks, funding pressure and their ability to finance investment. And I think that, you know, in the theory, I had to resort to a theory because, of course, we don't have any real world examples of where central bank digital currency has been in place, or at least in a significant way.
Yeah. So,
But in
and how
the,
would, sorry,
yeah,
continue.
yeah. So in the model, what happens is yeah. I mean, if the central bank was to like offer it's this product and kind of offer you know, I call it the CBDC rate, an interest rate on these reserves, basically, that are available to you and me. And as long as it kept the interest rate below the interest on reserves, the interest rate it pays on reserves that are held by banks. So that's the case I considered. So yes, it will put pressure on the commercial banks, because now they're going to have to compete more aggressively for deposits. And that's what they do, because this is a very cheap form of funding. They're going to be compelled to raise their deposit rates in order to retain this very cheap deposit funding. And it's they're doing this because at the very least they can redeposit at the Fed for higher interest on reserves. They're making a spread on this. It's like risk-free arbitrage, and so they're making this spread. So the spread is diminished, though. So the effect would be to diminish profit margins for the banks. And then we could have a discussion about whether this is desirable or not. But interestingly, in the model, by increasing the deposit rate, or generally making deposits more attractive to the population, what it does is it causes a substitution out of cash into electronic forms of payment. So you actually see a substitution out of currency into deposits that actually expands the deposit base for banks.
But it's in a positive interest rate climate, of course. We're currently in a zero or sometimes even negative interest rate climate. How are you going to make sure that people can still want to hold central bank digital currency if they have, at least with cash, they have not a negative yield with central bank digital currency? If you can never go negative, because then people will resort back to cash.
I kind of, you know, I have a little bit of a nuanced view on that. I think that what you describe is true for small accounts. So like if I have a $500 in the bank or $100 in the bank, and the bank starts charging me significantly, you know, significant fees or negative interest rate, I'm going to withdraw that $100 and keep it under my mattress. I refer to $100 because $100 is the maximum denomination of a US note. But if you want to think about it from the perspective of corporate users, who might be dealing with 50 million or $100 million of cash, I just don't see it. I mean, they're not going to withdraw $50 million, $100 million in $100 bills. So I think that actually the scope for going negative is actually quite larger, I think, than most people recognize.
But then for the big accounts, for the corporate accounts, if they start moving cash from or currency, digital currency, from the commercial bank to the central bank, then for those entities, funding issues for commercial banks can be possibly more severe, because in the most proposals I see about central bank digital currencies, that they really want to limit it to small amounts, usually tailored towards customers, small like private individuals. Or how would you go about then with the corporate accounts? Would you also limit them to a certain amount?
Well, I mean, first of all, whether or not the banks would suffer funding issues, I think, is a matter of debate. I mean, as I said, certainly they're going to have to compete more aggressively for deposits, and that means raising deposit rates. I mean, arguably, that's a good thing for us. Bank profit margins might be squeezed, but the effect on the ability of banks to finance their assets depends on the opportunity cost of the funding. And remember, I said, as long as the CBDC rate is below the interest on reserves rate, the relevant opportunity cost is the interest on reserve, not the CBDC rate. If you don't change the interest on reserve, you haven't changed the cost of funding, and you haven't the opportunity cost of funding. It should not have any effect on the ability of banks to finance their asset portfolio. So, you know, that's one thing to keep in mind. The other thing is that kind of there's two other things to keep in mind, is that, this is all predicated on the assumption that the Fed or the central bank is actually pursuing a particular monetary policy, like targeting the interest rate. So if the interest on reserve is an interest rate that the Fed wants to target, it's going to have to inject reserves or funding or let banks borrow reserves if they're under funding pressure. The Fed is going to have to do that in order to meet its interest rate target. So again, this has nothing to do with CBDC. This has to do with monetary policy. The central bank is in a position to influence the interest rate, the opportunity cost of funding for banks. It's a completely separate issue than central bank digital currency, unless you assume that the central bank digital currency interest rate is equivalent to the interest on reserve rate. So that's one thing. In terms of restricting access to just retail and not the corporate customers, again, I mean, when I write these things down theoretically, I go, why not open it up to everybody? Cash is available to everybody, albeit cash now is small denomination. But, one could make the argument that, because corporate users today are because of deposit insurance is limited, corporate users often go to the shadow banking sector. And we know the shadow banking sector is exactly where all the problems happened in the financial crisis. And so actually, if we could offer this product for corporate users and disintermediate the money funds, this might actually contribute to financial stability. Of course, the money funds and people operating in the shadow banking sector are going to complain, but from the perspective of a policymaker, you can't be concerned about just one group of people. You have to evaluate the program from the perspective of what's good for society.
Exactly. So one argument or one merit could be then that the introduction of central bank digital currencies or more base money basically would lead to more financial and economic stability, albeit perhaps at a price of less direct growth or maybe less liquidity, but a more stable, moderate growth without too many swings.
Yeah, and I'm not sure about the less liquidity statement. I mean, what can be more liquid than a central bank digital currency? I mean, it's about the most liquid object that we have out there.
Yeah, and what would be other merits for a consumer or for an individual household? What would be the advantage of keeping your money at the central bank instead of a commercial bank where there's also deposit insurance in place and possibly even a higher interest rate?
It's a good question. And again, so much depends on what specifically one means about the CBDC, the central bank digital currency, what design. I mean, there's so many possibilities, but, one thing to keep in mind is, one option that I'm particularly fond of is central bank digital currency as a public option, as a basic public utility. And so in this vision, most of us would continue to keep our bank accounts with private banks. I mean, private banks have, we develop relationships with our bankers. I mean, they provide us with a lot of other ancillary services. But at the same time, all of us could also have a basic utility level central bank account where you could send money to anybody in the country for free. So the vision of this facility as a basic public option is, look, make it no user fees, no minimum balance requirements, which is actually, a lot of people cite in the United States, you have a kind of a significant unbanked population. And about half of the people who respond to surveys about why they're unbanked point to the fact that the minimum balance requirement, they just don't have enough money to meet the minimum balance requirement, for example. So no fees, no minimum balance, it's a no frills thing, no overdraft privileges, fully insured, and real-time gross settlement. So you'd get paid instantly. For me, this just makes a lot of sense. It's kind of just like a public utility. It makes a lot of sense that because, at the end of the day, when you're talking about payments, you're talking about debiting and crediting accounts. It's not rocket science. You need the infrastructure in place, of course. Yeah, it has to be financed in some place, but my view is you can finance that the same way you finance public roads, public sidewalks, public schools. And I think that actually another merit of the program is, apart from what I think are the economic benefits, I think that there's a smart political reason for doing this, because it would go to some way to leveling the playing field for small business owners who are typically operating on very thin profit margins, who, using cash is kind of cumbersome. It's costly. You have to like rent a truck to transport it safely to the bank. It's filthy. If you use the electronic means, you're subject to relatively high interchange fees. So for small businesses, this is an issue. I think it could go to some way to mitigating the unbanked problem. And so from my perspective, I kind of look at the landscape in the United States and all, and what I see is there's a number of privileged players in the field. Banks, for example, have access to real-time gross settlement. Using Fedwire is almost free, especially relative to the volumes are transacted. They're fully insured. These privileged actors have all these benefits. Why not toss the broader population a bone, so to speak? And I just think it would be a good idea.
Yeah, and in terms of monetary policy, do you think you can also implement more effective monetary policy in case you can directly give money to the people? If, for example, helicopter money could be distributed using those central bank accounts that citizens have, do you think you can be more effective as a central banker?
Right. And so I like to couch this as not so much as just the responsibility of the central bank, but kind of jointly with the fiscal authority. So I think, they need to work closely in collaboration. So certainly that would be a side benefit, I would say. If everybody had an account with the central bank, it would be you'd see just the CARES package, the money that was passed, for example, for the COVID crisis, the money would just instantly appear in everybody's central bank account. Now, that's not to say that that can't be done with other ways. I mean, presumably this could also be done with Treasury Direct. It could be done through the Treasury or through the private banking sector as well. But I mean, obviously, if everybody just had a central bank account, it would just be a very simple matter. If you had authorization from Congress, that the Fed could credit everybody's bank account instantaneously. And of course, there's also the interest rate tool that could be used, especially it could be limited to kind of large value accounts. So for example, corporate users, maybe for retail users, you might not do so much, but you could obviously even go into negative territory for corporate users, and kind of it could be kind of a way to implement negative interest rate policy. And some people have argued that might be desirable in some circumstances.
Yeah, and that's maybe a critic would argue that it would be a central bank's dream to eventually also get rid of cash, so you can also implement a negative interest rate policy for smaller accounts. But in a lot of papers I read also from the ECB, they always say it has to be implemented as a complement to cash. So it seems like for the foreseeable future, cash will still be around. What's your personal opinion on cash? Do you think we need to eventually get rid of it, or do you want to keep it for a long time?
Central bankers don't speak in a uniform voice. I'm a central banker, and I certainly wouldn't say it's my dream to see cash disappear.
Good to
know. I think that there's a nice paper by Charlie Kahn, Jamie McAndrews, and Will Roberts that they published in 2005, where they state cash is privacy. There might be a lot of reasons for why one would want, or as a society, to tolerate or actually permit cash to continue to circulate. And obviously, despite being a very old technology, there's something really amazing about cash that's difficult to be replicated digitally. I mean, it preserves a lot of anonymity. Maybe one day electronically we can replicate the properties exactly, but cash is, you don't have to relinquish your identity. When you have to open up an account at the Fed or the Treasury, you have to, some people don't have addresses, for example. And, there's certain types of purchases that are, that might be technically illegal, as Larry White has recently remarked, but that are not, they don't do any harm. And we should perhaps we would want people to facilitate have an exchange medium for that purpose. Now, my own view is it's not necessarily clear to me why the central bank should provide that object. Let Bitcoin perform that function. I mean, perfectly happy to let private solutions also address the need of that constituency. I don't think it's something that we should endeavor to banish.
And it's interesting that you mentioned it, because I saw it also in one of your papers from 2018 that you're actually quite supportive of also more innovation in private currencies. Mm-hmm. If I look, for example, in Holland, the central bank here has decided to very narrowly adopt new AML directives from the EU, and is requiring all the Bitcoin companies in Holland to ask for elaborate information from their customers before they can transact, which seems a little bit like counter to what you're just saying, because if we on the one hand want to allow those companies or allow communities to come up with their own currencies, but at the same time we enforce all sorts of KYC and AML requirements, then we don't really give those currencies a chance, I believe.
Yeah, it's a difficult question, right? I mean, ideally, I guess what I had in mind was, small value transactions. And you notice that we have not outlawed bearer instruments completely in this country or elsewhere. I mean, central bank paper bills are bearer instruments. Many other types of bearer instruments have been outlawed. And these small the willingness to tolerate small denomination is that the idea is that it's basically small value transactions. For large value transactions, tens of millions of dollars or something like that,
Yeah,
I mean, you're going to have to, there are some trade-offs here, right? I mean, what is being financed with these things? I mean, I think society does have a legitimate concern about unknowing where this money is going, and it's just a really tough, tough cost-benefit analysis to make. But yeah.
Yeah, so privacy for the people and transparency for the powerful.
Yeah, I think maybe that's a very nice way to put it, in fact, yes.
Yeah, and so would you then also consider, because you mentioned two different types of central bank digital currencies. On the one hand, you can have an account-based currency, but you can also work with digital bearer instruments. Do you have a preference yourself, or do you see certain trade-offs there?
So again, I mean, I think the trade-offs are kind of related to what we were just talking about. So as you mentioned, that's right. When I was when you asked me early on what is central bank digital currency, I gave you the basic version, where from the perspective of a user, it'd be indistinguishable from just when you go online, you look at your account balances online. You just have an account with the Fed. And of course, this account would be insured, fully insured, instead of just up to $250,000. And you'd have to, supply information to the Fed, your identity, your address. There might be other personal information you have to reveal and all that. The same sort of, you'd have to go through the same procedure as opening up any bank account. The other vision of this is something that I think J.P. Koning talked about in 2015 called Fedcoin. And I also blogged about it back then. Actually, I think J.P. talked about it even earlier, maybe in 2013. And the idea there is that, the one thing about cash, physical cash, is that it is a bearer instrument. It's permissionless. You don't have to fill out an application form to use cash. You don't have to reveal your identity to use cash. You don't have to, the KYC, AML things, I mean, I guess don't really hard to enforce, even if they were applied to cash. So it's a permissionless bearer instrument. And the question is, if it was feasible, and I think it is, would it be desirable to actually provide the digital analog to that physical object in the form of a digital bearer instrument? One where instead of, you do it just like Bitcoin. Instead of supplying information that reveals your identity, you just download a free wallet software from the internet, and you'd kind of open up an account, kind of like an anonymous Swiss account, right? An anonymous Swiss bank account. That's basically what it would be like. And then, you know, I would send my money from my account to your account, and we wouldn't necessarily know who we are. I would just set an instruction, and this digital bearer asset would just be debited and credited across accounts on the Fed's ledger. But the Fed wouldn't necessarily know who I am or who you are. So that's kind of a digital representation of what already happens with physical cash. So that's kind of the other vision of central bank digital currency. I could actually kind of see the two coexisting, you know, kind of the account-based and the token-based if you wanted to. The digital version, the bearer asset version, of course, suffers from the problems you just alluded to, kind of the KYC, the AML considerations.
Yeah. And how can you avoid someone is going to create millions of those accounts if
yeah, I mean, you know, so even if you were to restrict kind of the like small denomination accounts, I mean, a person could have 1 million accounts. Yeah. And so you have that tension. And I don't know what the answer is to that question. But I think it's interesting to think about, and people are actively debating these issues, and I think we just have to wait to see what the resolution is.
Yeah, because it's interesting in this age of power that big tech companies have, for example, and our data is very much being controlled by all these Silicon Valley companies. Then the good old central bank may even come at the forefront of protecting our payments data, and
it would be ironic.
Yeah, right. It's interesting.
The central government as the institution that protects us from the private sector.
Yeah.
So there's all our personal data. Yes.
Yeah, interesting. So there's lots of pros and cons then when it comes to implementing digital currency. What I wonder also from a balance sheet point of view is this. I understand on the liability side of a central bank, currency is created, but what do we see on the asset side of the central bank?
You know, I mean, you could just exactly what you see now. I mean, primarily just U.S. Treasury securities or government bonds, but in principle, it could be anything.
So let's say if Treasury wants to distribute money using the central bank accounts, they would just credit the accounts of all the citizens, and their account at the central bank would be debited, and they get their money by issuing bonds, and that's how the mechanism would work then.
Well, I guess literally, let's see, let me think about that. Maybe, I mean, literally, I mean, at the end of the day, we shouldn't lose sight of the basic operation of what you just described, which would be literally just to create balances in people's accounts.
Yeah.
How the accountants deal with this on balance sheets, like the Treasury's balance sheet and the Fed's balance sheet, I mean, to be honest, I mean, I don't know. I mean, this is accounting. It's to me, it's secondary to the primary economic impact. It's you're just creating digital purchasing power that may have some desirable effects and may have some undesirable effects. I mean, who knows? But the way it would work, I mean, practically is you know, the Treasury would issue a Treasury security, like a T-bill. And in the United States, the Fed is prohibited from actually purchasing it directly. But in Canada, for example, you can do it. So you go through some process, but effectively, the central bank would purchase that Treasury and put it on its books as an asset. What is this Treasury? It's just an electronic digit account living on some ledger somewhere in New Jersey, I guess. So it's just literally just an operation to credit your account with these digital interest-bearing assets. And then the way you finance it is by crediting the Treasury general account on the liability side of the central bank by an equivalent amount. I mean, it's just bookkeeping. I mean,
yeah. But in the US, it's more difficult in a way than in other countries, because in most countries, the central bank is just owned by the government. So you might as well consolidate the balance sheets and you're done. And then ultimately, it's just the government issuing money, whether they do it via the central bank or via the Treasury. It's the same balance sheet if you consolidate them. But in the US, of course, the Federal Reserve is as federal as the Federal Express, owned by commercial banks. So in a way, you can also decide, of course, in the US for the Treasury to open accounts for citizens. Treasury digital currency. They don't necessarily need a central bank for that, right?
That's absolutely correct about. I mean, I'd push back a little bit about the Fed being owned by private interests. That's the Fed is a complicated beast. I mean, it's kind of a quasi public private, mix. It is true that the regional feds are private corporations. So myself, for example, I'm not a public employee. I work for the St. Louis Fed as a private, incorporated as a private corporation. But the shares are not tradable, and the shares earn a 5% dividend. This is in the Federal Reserve Act.
Yeah.
And all the profit that the Fed makes, the seigniorage and all the profits, is remitted back to the taxpayer. So in that sense, it's kind of owned de facto by the public sector. And moreover, the Board of Governors, which is in Washington, D.C., they are government employees, the federal, and they're kind of at the center of the Fed. So I wouldn't get
but you can't consolidate the balance sheets, right? For example, take the UK, the Bank of England and the UK balance sheets, they could be consolidated into one government-owned balance sheet.
Well, I mean, I don't know what that means to consolidate in
from an accountancy point of view,
time.
like from an accountant point of view.
Yeah, so I can take a look at these balance sheets and I can say, well, I can look at them separately or I can consolidate them. I mean, maybe we're going off track here, but what was that? The second thing you were saying there? But yeah, I mean, look, we could bypass the Fed entirely here. I mean, everybody should have an account with the IRS, the Internal Revenue Service. This could all be done. And by the way, I don't know if people are aware. I mean, today in the United States, every U.S. person has access to online accounts at the U.S. Treasury. You just go to www.treasurydirect.gov and you can open up an online account with the Treasury. And you can, you just see there your interest-bearing balances of various Treasury securities. And of course, Treasury bills are very close to interest-bearing reserves.
Exactly.
Now, if everybody can open up an account with the Treasury, I mean, the Treasury could do this directly. They could just credit everybody's account at the Treasury. And then, of course, you could move the Treasury money to the banks or whatever.
Yeah, so there are a lot of different variations possible. Yes. And it seems like China is ahead, right? Because they are already piloting their digital yuan in the Shenzhen area. And I believe they want to be ready before the Winter Olympics early 2020 in Beijing. What do you expect next year in this field? Do you really see central bank digital currencies become already big in China, or what's your view?
Yeah, it's a good question. I have to confess, I haven't been following too closely the actual experiment in China or even elsewhere. I mean, I'm familiar with what they're doing, and also, of course, the Riksbank in Sweden is a leader as well, among others. But my question is, from the perspective of somebody who doesn't know the details of what's going on, I would just step back and go, oh, the Chinese are offering their own central bank digital currency. And I'm going to go, so now people can open up bank accounts with the Central Bank of China. I mean, who cares? I mean, how is that different than opening up a regular bank account where I can already get digital currency? I just don't see what the big deal is.
Well, as an economist, it would be an interesting experiment, of course, to see if indeed that would lead to certain funding issues for banks, or it would lead to other problems foreseen by commercial bankers, or of course, it's an interesting social experiment that could also lead to conclusions on your end, or maybe in Europe, to see whether they do want to go ahead with it.
Yes, but like I said, so much depends on design. So much depends on, so for example, in the United States, I mean, banks can borrow from the Fed already. I presume that's the same in China. So if the banks in China experience funding pressure,
they go to the central bank. Yeah.
And if they become, they can go to the central bank, and then the central bank has to make a decision. Do we want to? Is this a legitimate request of funds? And if it is, they'll provide the funding for the banks.
Yeah. So you're saying a funding problem will never occur as long as the central bank is the lender of last resort and is willing and able to lend reserves to.
Correct.
To any commercial bank. Great.
Correct.
One final question. We've seen Bitcoin rise a lot price-wise over the past few weeks. To what extent are central bank digital currencies, at least for ordinary people? Are they going to be a threat for cryptocurrencies? Are they going to coexist? Your take on that, please.
Well, my answer to that question is, when I take a look at history as a guide, and when you take a look at history, what you see is a broad coexistence of all types of currencies. You typically have a dominant currency, the unit of account, like the US dollar in the United States. But in the United States as well, if you go and look, there's several local currencies, dozens, even hundreds. The Ithaca hour in Ithaca, New York being a kind of a main example. So these local currencies that serve the specialized need of local constituents have circulated in the past, circulate today, continue to circulate despite the dominance of a dominant currency. And so my own view is, I'm very, again, agnostic on this. I think that all of these cryptocurrencies, they all differ a little bit. I mean, Litecoin might offer things a little bit different than Bitcoin, and some other product might offer some more anonymity, whatever. So they're all designed to serve the needs of a particular constituency. And I think they all have their niche markets that they're going to continue to serve no matter what happens. So if the central bank is going to offer its own digital currency, I do not foresee it displacing Bitcoin. Not entirely. And I don't know, it might even be complementary for all I know. I don't know. Bitcoin is serving a very different need. Bitcoin is not a good exchange medium. It's not very good for a number of reasons, not the least of which it's not a unit of account in most jurisdictions. But it's potentially serves a pretty good store of value, and it's potentially a good way to move large amounts of money pretty cheaply, kind of relatively anonymously. So I foresee, and I've said this from the very beginning, from 5-6 years ago, I think I gave my first public lecture on Bitcoin. I said I could see, this product serving the needs of the constituency. So I think it's going to continue to be there. I don't think it has anything to fear. I think we should look for coexistence with each of these products serving the needs of the constituents.
Yeah, like an ecosystem, like Bernard Lietaer used to say when he was still alive. Well, thanks so much, David. Anything you want to add to the conversation?
I think we've covered a lot of ground, Paul.
Yeah, it was very interesting. Yeah, thanks so much for being on, and I'd love to do it again in the future.
Absolutely, it's been my pleasure. Thank you.
Thanks a lot. Bye.
Sure thing. Bye.